10 days ago, I did a video talking about 3 cheap stocks to consider in the stock market trading under 10 times earnings. You guys really enjoyed it. I got a lot of positive feedback and you asked me to do one every single week. And I said that I can't really do that, but I decided to do pretty much 1 or 2 videos every single month where I go through a screener and I randomly select 3 stocks to try to analyze live here in the video and try to determine if these stocks are cheap for a reason, are they value traps, or are they maybe amazing buying opportunities. For example, I did find 2 value traps in my previous video, but I did find one gem that I believe is Crocs. I think it's not a value trap. I think the stock is extremely undervalued. You can watch the video. And I also had the same experience here. This is a basic screener from Finviz. I just put below 15 times earnings and some kind of a technical level, 0 to 10% above the low. So somewhere close to their 52-week low with very bad sentiment. We're going to look at 3 of them, random picks, and try to determine if they are value traps or they are actually amazing buying opportunities. Now, the first one that's trading below 15 times earnings is actually trading at 13 times earnings, and Bill Ackman owns the stock. I believe he still owns it. And this is Lowe's Corporation, ticker symbol LOW. The stock is sitting at $186 per share, pretty close to where it was trading at before, somewhere in 2021. Bill Ackman likes it. I never owned Lowe's personally. I always owned the Home Depot. I bought it in March 2020 and then I sold it. I owned it before March 2020. So I always preferred Home Depot over Lowe's. I think Home Depot is better managed and I believe it's growing a little bit faster than Lowe's. But Lowe's has a pretty interesting story. And I believe a lot of retail investors, they get fooled with this stock thinking it's deep value, or a lot of dividend investors love it because they increase the dividends like 10 or 15%. And they do increase the dividends. The dividend is pretty amazing within Lowe's if this is all you're looking at. But if you look at the bigger picture and you look at the revenue change or the revenue growth for Lowe's, it's pretty much non-existent. The stock before pre-COVID, the earnings or the revenues, they grow around 4%, 1%. They did have a massive COVID jump, 24%, and then 7%. 2023, which is 2022, was pretty much 0.8%. And now fiscal year 2024, which is 2023, is a decline of 9.4%. And then 2025, 2026 is around 1 to 3%. So the revenue growth is pretty much non-existent, 1 to 3% revenue growth. Now, what's interesting enough is if you look at the EPS growth, it's way above, the revenue growth. EPS 16% versus 4%. 12% versus 1%, 54% versus 24%, 35% versus 7%. Now, how is this even possible? One of the reasons EPS was growing so much faster than revenues was because Lowe's was improving their net income margin. Their profitability was improving. This is amazing. But there's another reason why the EPS has been growing so much faster than pretty much everything else. And this is mainly because of the shares outstanding going down. Lowe's has been buying back a lot of stock and it kind of inflated the EPS per share. Now you might say, what are you talking about? This is amazing. The company is reinvesting back in the business. It's taking owners out of the business and then EPS going up, shares outstanding are going down. This is pretty amazing. And yes, I agree, but we have to look of how Lowe's is actually, using the money to buy back stock. Where are they getting the money from? You might believe it's from the free cash flow, but it's not from the free cash flow. Because if you look at the free cash flow of the company, the latest one is $6.7 billion. Now they pay out $2.3 billion in dividends. This would leave them with something like $4.2 billion to buy back stock. But this is how much they bought back stocks. They had $4.2 billion left, but they bought back $14.1 billion worth of stock in fiscal year 2023. In 2022, they had something like around $7 billion or $6 billion left of free cash flow. They repurchased $13 billion worth of stock. Now, how was Lowe's able to do that? Well, they did not take the free cash flow and they bought much more than the free cash flow. The main way they were able to do that is by taking on massive amounts of debt to buy back stock. And this is, I believe, from the management. Maybe they have some kind of a metrics they want to hit to get their, stock-based compensation and bonuses. Maybe their incentives are more on EPS per share. So they are borrowing money to buy Lowe's at any price. If Lowe's is sitting at 52-week high, if the multiple is high or the multiple is low, Lowe's management are still buying back stocks. They are borrowing money to buy back stock. And this is pretty amazing. This is why the EPS is so high. But I don't believe this is very sustainable over the long term. And I believe it's deceiving a lot of retail investors, in my opinion. So you have to be careful. And how much more can Lowe's keep borrowing to just buy back stock? And they're not like buying back stock at crazy low levels. They've been buying stock pretty much at any price. The debt has been increasing pretty much almost every single year. And if you look at the multiple of the company, it's now sitting at 13 times earnings, 13.4. Now the mean is 17.7. So there's no revenue growth. There's only EPS per share growth. Most of the EPS per share growth is due to Lowe's borrowing a lot of money. And now the cost of borrowing money is much, much higher. So if they borrow money to buy back stock, it's going to eventually eat into the profitability because of higher interest expense. And, they did have some cash, but not enough to do all these $30 billion worth of buybacks that they were doing with something like $6 billion of free cash flow. So again, I'm not a big fan of Lowe's. I mean, I have to be honest. I think there are much better opportunities in the market. Now, if Lowe's crashes to something like 10 times earnings, I think it would be extremely interesting. But at this price, Lowe's will most likely recover eventually in the future. Now, the second stock that came up on the screener trading around 8 times earnings, I believe, or 9 times earnings, and this is AEP, which is Advanced Auto Parts. Advanced Auto Parts has been an absolute disaster of a stock. It was sitting around $250 per share. Now it's sitting at $50 per share. And if we look at Advanced Auto Parts, just net income margin, just to show you how poorly this business has been mismanaged pretty much. Advanced Auto Parts net income margins are around 4.8% to 5%. Now you look at AutoZone, net income margin, are around 13 to 14%. This is the same industry, the same business. Advanced Auto Parts is at 5%. AutoZone is around 14%. O'Reilly is triple Advanced Auto Parts at 15% and even around 16% in some of their years. So, I mean, this is just massive mismanagement with the companies. It needs some kind of an activist that's going to flip the entire business around, and it could have some potential. But I believe their reputation has been, somewhat ruined. It might be able to be fixed. But even if you look at the return on capital, Advanced Auto Parts return on capital is 12%, AutoZone is 42%, and O'Reilly is at 49%. I mean, what is Advanced Auto Parts doing? They've been just doing dividends. So it's a massively mismanaged company. If you look at their, something like the guidance, and this is how I'm going to value the stock. This is how I valued it before. And I told people my fair value on Advance was $40 per share when the stock was sitting at $120. And everyone laughed at me as usual. This is just because sometimes my price target is outrageous. But it's actually playing out in real time. And now the stock is sitting at $50. So the way I look at it, I look at the free cash flow guidance. It was 200 to 300 million. Which was extremely low. I thought this would be the lowest number. But they apparently revised it even lower, between 150 million to 250 million. So I take pretty much the medium of that is around 200 million of average free cash flow. Now, from me looking at other opportunities in the market and looking at Advanced Auto Parts, which has little to no growth and it has a lot of debt and mismanaged, I would personally not be willing to pay more than 10 times free cash flow for something like Advanced Auto Parts. So I take the 200 million and then, we time it by 10. This is a $2 billion market cap. And if I divide that by the shares outstanding of 59.8, I get around $33.85 per share. So my fair value on Advanced Auto Parts is even lower than it is right now. It's, something pretty close to $33. $33 is what it was trading at in 2009. I'm not sure if it's going there, but I'm not interested in the stock. But if Advance ever gets to like $33 or $35, I personally believe the stock would be much more interesting. Now, another interesting stock that came up on the screener, and I believe this has a lot of potential, and this is a Warren Buffett stock, and this is HPQ, which is HP. Most of you are familiar with HP printers, HP computers and equipments and many other things. They are pretty popular all around the world. The stock has been, under the radar, but then Warren Buffett started buying HPQ and it got pretty popular. The stock started going up. It was amazing. But recently, Warren Buffett, after he bought HPQ, he has been selling a lot of the stock. He's been selling a lot of it. You could just see Berkshire Hathaway, 10% owners, they've been selling 3 million, 1.6 million. They've been selling a lot of, HPQ. Maybe Warren Buffett does not like it anymore. The company did kind of disappoint. And I'm not sure why he even bought it from the beginning. It's not really kind of the best company you could buy. But if you look at the free cash flow yield of the company, it's trading at a ridiculously low free cash flow multiple. The free cash flow yield is 16.4%. which is very, very high. I mean, it's trading like a bankrupt company. Now, 16.4%, normally companies that have this kind of free cash flow yield, they normally tend to have a lot of debt. And this is why if you look at a market cap, it does look at 16%. But if you look at enterprise value, it's something like 4 or 5%. But it's not really the case with HPQ. HPQ does have, some debt. They have 1.7 billion of cash. If you look at the long-term debt, it's only 9.2 billion. So in terms of net debt, this is something in the $7.5 million range. But they do also have something called other non-current liabilities, which is another word for long-term debt. So in total, it's like 11 or 12 billion, which is a lot of debt for something like HPQ. But in my opinion, this is somewhat manageable because the company has very resilient free cash flow. It does not grow. It's not growing at all. You could see it's pretty much the same it was in 2017. Now it's 3.1 billion. In 2017, it was 3.2 billion, and it's expected to be in the 3.3 billion dollar range, over the next 2 to 3 years. So the free cash flow is not growing, but it's pretty stable. And one of the reasons it has been so stable for HPQ was because of the printing business. The printing business has much higher operating margins, 18.6% versus the personal system of 6.6%. And it's mostly recurring revenue because the printing supplies and commercial printings and stuff, and people use the ink, they use the papers and all these kind of things. A lot of them are signed up on a subscription service with HPQ, where the first of every single month they deliver them ink or whatever they use in terms of the printers, whatever you want to call it. So it's been pretty stable. This has helped the free cash flow tremendously in avoiding fluctuating into a lot of cycles. So the free cash flow is stable with HPQ, which would give me a lot of safety for the debt that they are carrying. And if we look at the shares outstanding, HPQ has been aggressively buying back stock. This is how I think about this company. They have like a 4% dividend, and they are buying back a lot of the market cap, 4 to 5% every single year. So in total, I would get something like 8 or 9% every single year from a shareholder's yield. So if I owned HPQ, it got no multiple expansion, the free cash flow did not grow, everything is still the same. They use some of it to pay back debt. I would see 8 or 9%, which is a 4% dividend, and a 4% or even 5% of them buying back the shares outstanding down every single year. And it has been pretty amazing. But again, the business is not growing. Looking at the market cap to free cash flow multiple, now it's sitting at 6 times free cash flow. The mean is 8.4. So it's not very, it's not like much lower than the mean or anything crazy. And the lowest HPQ has traded at was something like 3.7 times free cash flow. So the stock could still drop another 30 or 40% just to get back to the lows of 3.7 times. So it's very risky for me, but this is my favorite one out of those 3 stocks. I think it has a lot of potential. The company, again, it's not growing. Without a multiple expansion, I see 8 or a 9% return every single year. And a lot of you can do something like sell covered calls on it, collect the dividend, do the buybacks, and then sell the covered calls. You could get maybe 14 to 15% annual every single year on something like HPQ. This is what I would do if I wanted to own it. This is what I normally do with a lot of stocks that have a high dividend yield. Like if I ever bought BTI or Verizon, I tend to sell covered calls on them and collect another yield because they don't move much. This is pretty perfect for something like HPQ with pretty resilient free cash flow. So this was my video for today on 3 cheap stocks to consider. We reviewed them, we analyzed them. Now, pretty much tomorrow or in a few days, I'm going to post my 2 undervalued stocks to consider. These are 2 stocks that are not value traps, but I personally am extremely bullish on. I do this video on the 1st of every single month, so stay tuned for this one. Thank you again for watching. It was not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.